Assalamualaikum and a good day to Dr. Mara and all my fellow friends. We are Amigos. We present to you a topic about liabilities. The table of content for our presentation today. First, we will give the introduction about what is liability. Second, we will explain to you what is the financial liability. Third, we will explain to you about what is provision. Fourth, we will explain to you what is the contingent liabilities. Fifth, we will present to you about what is the other liabilities. And the last but not least is the issue and the summary of the topic. I will start this presentation to give the introduction about what is liability. According to the conceptual framework for financial reporting, it's defined that a liability is a present obligation of the entity to transfer an economic resource as a result of the past event. There are three criteria must all be satisfied for liability to exist. First, the entity has an obligation. Second, the obligation is to transfer an economic resource. Third is the obligation is a present obligation that exists as a result of the past event. According to the MFRS 137 paragraph 10, it's defined that there are two types of obligating event. First is the legal obligation. It's an obligation that derives from a contract, legislation, or other operation of law. The second type is constructive obligation, which is an obligation that derives from an entity action where, by established pattern of the past practice, publishing policy, or suspiciously specific current statement, the entity has indicated to other party that it will accept certain responsibilities. And as a result, the entity has created a valid expectation on the part of those other party that it will discharge those responsibilities. Now, I will show to you classification of liability in financial position statement. According to the MFRS 101 paragraph 60, it says that there are two ways on how to present the liabilities in financial position statement. The first way is we will classify this liability according to the non-current and current liability, which you can see in the Eon Credit Service Berhad financial position. The second way is we will classify this liability according to their liquidity, as you can see in the Maybank financial position statement. There are four types of liabilities. First is financial liability. Second is the provision. Third is contingent liabilities. And the last but not least is the other liabilities. Now, I will explain to you what is the financial liability. According to the MFRS 132, it's defined that a financial liability is any liabilities that is a contractual obligation, which is to deliver cash or another financial asset to another entity, or to exchange financial asset or financial liability with another entity under conditions that they are potentially unfavorable to the entity. A contract that will or may be settled in the entity's own equity instrument is one of the financial liability, which is a non-derivative for which the entity is or may be obligated to deliver a variable number of the entity-owned equity instruments, or a derivative that it will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity-owned equity instruments. This is the example of the financial liability in statement financial position. This is a CIB Group Holding Berhad financial position statement. Now, I will explain to you the financial liability can be classified into four groups. First is amortized cost, which is financial liability that all financial liability except those meet the criteria for other classification. The second group is the fair value through profit and loss, which is the financial liability. In this group is the financial liability that for trading, derivative financial liability, and financial liability that designated at the initial recognition. The third group is the financial guarantee contract and a commitment to provide a loan at a below market interest rate. The fourth group is financial liability resulting from the unqualified transfer of a financial asset for this recognition, which is in this group, the financial liability for the consideration received is recognized. Now, I will explain to you how to subsequent measurement the financial liability group. The first group is amortized cost. For the financial liability at the amortized cost, it will subsequent measurement according to the amortized cost using effective interest method. The second group is the fair value through profit and loss, which is it will be subsequent measurement at the fair value will all gain and loss been recognized in profit or loss. The third group is financial guarantee contract and commitment to provide a loan at the below market, which is market interest rate. The issuer shows subsequent measurement at the higher amount of the loss allowance determined or amount initially recognized less cumulative amount of income recognition. The last but not least is the financial liability resulting from the qualified transfer of the financial asset for de-recognition. This financial liability will be subsequent measured at the amortized cost of the right and obligation retained, or the fair value of the right and obligation retained by the entity when measured on the standalone basis.
Okay, let us proceed with a few examples. As we can see in the slide, there are some examples of amortized costs from financial statement of Hong Leong Bank Berhad. For financial liabilities at amortized cost, they are fixed deposits, negotiable instruments of deposit, and short-term placements. Here we can see financial liabilities are initially recognized at fair value plus transaction costs. Subsequently, financial liabilities are remeasured at amortized costs using the effective interest or profit rate. For financial liabilities at fair value through profit or loss, we can see from the significant accounting policies of CIMB Group Holding Berhad. It is initially measured at fair value and subsequently the fair value is remeasured and any gains or losses are recognized in the statement of income. For financial guarantee contracts from CIMB Group Holding Berhad, it is recognized as financial liability and initially recognized at fair value on the date the guarantee was given. Subsequently, it is measured in accordance with MFRS 9, paragraph 4.2.1. So, let us move on MFRS 7, which discusses disclosure of financial liabilities. Basically, there are two things that need to be disclosed under MFRS 7, which the first one is the significance of financial instruments for financial position and performance that consists of the disclosure on statement of financial position, and then statement of comprehensive income and other disclosures such as accounting policies applied. And the second one is the disclosure of nature and extent of risk arising from financial instruments that require disclosure on credit risk, which are more related to financial asset, liquidity risk, and also market risk. Now, we are going to look at a few real examples of disclosure of financial liabilities by CIMB Group Holding Berhad. For disclosure on the statement of financial position, we are going to focus on the disclosure of financial liabilities designated at fair value through profit or loss in the notes to the financial statement. As we can see, deposits from customers, debentures, and bills payable are financial liabilities that are designated at fair value through profit or loss, and it discloses the carrying amount and the contractual amount at maturity, which is in accordance with MFRS 7. Next is the example of disclosure of a statement of comprehensive income, which according to MFRS 7, Para 20, it shall disclose the net gain or net losses either in statement of comprehensive income or in the notes to the financial statement. For the disclosure of liquidity risk, MFRS 7 require an entity to provide qualitative and quantitative disclosure for each risk. We can see from the notes to the financial statement they provide qualitative disclosure, which is basically an essay that consists of exposure of risk and how they arise and the methods used to measure the risk. Okay, by the way, liquidity risk in CIMB Group Holding Berhad arises from mismatches in the timing of cash flow, and the objective of the group's liquidity risk management is to ensure that the group can meet its obligations in a timely and cost-effective manner. For quantitative disclosure, it's more related to data disclosure on liquidity risk. As we can see in the notes to the financial statement of CIMB Group Holdings Berhad, they provide quantitative disclosure for analysis on maturity for derivative financial liabilities which fulfill the requirements of MFRS 7. For the next disclosure, which is disclosure on market risk, according to MFRS 7, qualitative and quantitative disclosure also need to be provided by the entity. As we can see from the slide, one of the methods used to measure the market risk is market risk COE, evaluates market risk exposure by using a applicable market price and pricing model. Okay, lastly, let us take a look at the example of quantitative disclosure on market risk, specifically in the interest rate risk of financial liabilities. As we can see from the CIMB Group Holdings Berhad, they disclose the net interest sensitivity gap which require MFRS 7 para 40. The requirement disclose sensitivity analysis for each type of market risk. Thank you.
I will present about provision in MFRS 137. So, what is the definition of provision? Okay, a provision is a liability of uncertain timing or amount stated in MFRS 137 para 10. It is different with other liabilities. Provisions can be distinguished from other liabilities such as trade payables and accruals because there is uncertainty about the timing or amount of the future expenditure required in settlement. By contrast, trade payables are liabilities to pay for goods or services that have been received or supplied and have been invoiced or formally agreed with the supplier, and accruals are liabilities to pay for goods or services that have been received or supplied but have not been paid, invoiced or formally agreed with the supplier, including amount due to employees. Although it is sometimes necessary to estimate the amount or timing of accruals, the uncertainty is generally much less than for provisions. Accruals are often reported as part of trade and other payables, whereas provisions are reported separately. In a simple word, provisions represent funds that a company put aside to cover anticipated losses in the future. In other words, provision is a liability of uncertain timing and amount. So, how do we recognize provision in MFRS 137? Okay. A provision shall be recognized when an entity has a present obligation, legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. If these conditions are not met, no provision shall be recognized. There is two types of present obligation in MFRS 137 para 10, which is a legal obligation and also constructive obligation. Okay, so the first one is legal obligation. Okay, legal obligation is an obligation that derives from a contract through its explicit or implicit terms, legislation, or other operation of law. The second one is constructive obligation, which is an obligation that derives from an entity's actions where, by an established pattern of past practice, published policies, or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities, and as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. These are the examples in legal obligation and also constructive obligation. In a contract, we have example such as warranties, legislation like taxation, other operation law such as criminal offence. In constructive obligation, we have past practice such as refund and valid expectation. The example is VRS, Voluntary Retirement Scheme. This is an example of legal obligation in terms of a contract, where the it recognizes provisions or not. Okay, the statement is a manufacturer gives warranties at the time of sale to purchasers of its good. Under the terms of the contract for sale, the manufacturer undertakes to make a good by repair or replacement, manufacturing defects that become apparent within 3 years from the date of sale. On past experience, it is probable that there will be some claims under the warranties. So, in this case, the obligation events is legal obligation, as it stated that the sale of the product is with a warranty. So, an outflow of resources embodying economic benefits in settlement. So, it is probable for the warranties as a whole. So, the conclusion is a provision is recognized for the best estimate of the cost of making good under the warranty product sold before the balance sheet date. The second example is about refund policy in constructive obligation. The statement is, a retail store has a policy of refunding purchases by dissatisfied customers, even though it is under no legal obligation to do so. Its policy of making refund is generally known. So, the obligation event in this situation is constructive obligation, because the conduct of the store has created a valid expectation on the part of its customers that the store will refund purchases. The second one is outflow of resources. It is probable a proportion of goods are returned for refund. So the conclusion is a provision is recognized for the best estimate of the cost for refunds. This is Huawei Investment and Holding consolidated statement of financial position as at 31st December 2021. The provision that this company anticipated for 2021 is 17,443, much lesser than 2020, which is 24,292. In Huawei Investments Holdings, Note 28, in its provision of warranties, it stated that it has 3,269 million provision for warranties. Compared to 2020, it has 5,023 million provisions for warranty. In Huawei context, the provision for warranties relates mainly to products sold during the year and is determined based on estimates made from historical warranty data associated with similar products and the amount of products covered by warranty at the end of the reporting period and their corresponding remaining warranty periods. Most claims are expected to be settled within 1 year. For Huawei significant accounting policies, which is for provision of warranties, it stated that the group provides assurance warranty on its standard consumer and certain enterprise products for a period typically covering 12 to 24 months. The group estimates the cost that may be incurred under its assurance warranty obligation and records a liability in the amount of such costs when revenue is recognized. Warranty costs generally include spare parts, labor costs, and service center support. Factors that affect the group's warranty liability include the amount of products sold, historical and anticipated rates of warranty claims. The group periodically raises its warranty liabilities and adjusts the amounts as necessary. For provision in specific circumstances, there are 3 things to be looked for, which is future operating losses, onerous contracts, and also restructuring. Okay, the first one, future operating losses. Provision shall not be recognized for future operating losses. Onerous contracts, unavoidable cost of meeting the obligations under the contract exceed the economic benefits. The lower of the cost of fulfilling it and any compensation or penalties arising from failure to fulfill it. And the last one, restructuring. Program planned and controlled by management that changed scope of business. Constructive obligation arise when detailed formal plan raise a valid explanation in those affected. Next, we move to other subtopic, which is contingent liability. So, what is contingent liability? Okay, it is defined as a liability which may arise depending on the outcome of a specific event. It is possible obligation which may or may not arise depending on how a future event unfolds. A contingent liability is recorded when it can be estimated, as it should be disclosed. So, there are 2 obligations in contingent liabilities, which is possible obligation and present obligation. Okay, possible obligation whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Okay, a present obligation that arises from a past events, but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. So what is the difference between provision and contingent liabilities? In MFRS 137 para 13, stated that provision is recognized as liability. It is reliably estimated and has probable outflow of resources. And for contingent liabilities, it is not recognized as liability. It is not reliably measurable and has uncertain outflow of resources. This is 7-Eleven Malaysia Holding Berhad, Note 33, contingent liabilities for possible obligation. So, in this case, it passes from Berhad to material litigation towards 7E. Okay, in MFRS 137 para 86, an entity should disclose a brief description of the nature of the contingent liability, which are nature, estimation of financial effects, indication of uncertainties, and some possibility of any reimbursement. The slide shows Ahmad Zaki Resources Berhad accounting policies, which is contingent liabilities. It include MFRS 137 para 10 and also MFRS 137 para 28 in it accounting policies of contingent liabilities. It stated that where it is not probable that an outflow of economic benefits will be required, or the amount cannot be estimated reliably, the obligation is disclosed as a contingent liability unless the probability of outflow of economic benefits is remote. Possible obligations whose existence will only be confirmed by the occurrence or non-occurrence of one or more future events are also disclosed as contingent liabilities unless the probability of outflow of economic benefits is remote.
Hi, my name is Amirul Hakim bin Yusri, and now I am going to present the next part, which is other liabilities. So other liabilities consist of 4 standards, which is MFRS 15 contract liabilities, MFRS 16 leases liabilities, MFRS 112 deferred tax liabilities, and MFRS 119 employee benefit. So the first part that we are going to discuss today is regarding to the MFRS 15, which is contract liabilities. So what is contract liabilities? MFRS 15 paragraph 106 stated that contract liabilities is an entity's obligation to transfer goods or services to a customer for which the entity has received consideration, or an amount of consideration is due from the customer. So provided below is an example of a contract liabilities for Aeon Corporation. So the presentation is stated on MFRS 15 paragraph 105. And on the other picture below, it stated that the contract liabilities primarily relate to the unredeemed customer loyalty awards, customer rebates, and unutilized cash vouchers. The amount will be recognized as revenues when the points and rebates are redeemed and cash vouchers are utilized by customers, which is expected to occur over the next 2 years. The next part is MFRS 16, which discuss about leases liabilities. So what is leases liabilities? Leases liabilities is a contract in which one party agrees to rent an asset owned by another party. Classification for leases liabilities are stated in MFRS 16 paragraph 61 and 62. So MFRS 16 paragraph 61 stated that a lessor shall classify each of its leases as either an operating lease or a finance lease, while MFRS 16 paragraph 62 stated that a lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership of an underlying asset. A lease is classified as an operating lease if it does not transfer substantially all the risks and rewards incidental to ownership of an underlying asset. Next, we are going to look at the recognition part of lease liabilities. So it is divided into 2 parts, which is lessor and lessee. So MFRS 16 para 67 regarding finance lease stated that at the commencement date, a lessor shall recognize assets held under a finance lease in its statement of financial position and present them as a receivable at an amount equal to the net investment in the lease. While paragraph 81 regarding operating lease, it stated that a lessor shall recognize lease payments from operating leases as income on either a straight line basis or another systematic basis. The lessor shall apply another systematic basis if that basis is more representative of the pattern in which benefit from the use of the underlying asset is diminished. For the lessee part, paragraph 22 stated that at the commencement date, a lessee shall recognize a right of use asset and a lease liability. Moving on to the next part, which is the measurement of leases liabilities. Measurement of leases liabilities is divided into two parts, which are initial measurement and subsequent measurement. So the first type of initial measurement is initial measurement of the right of use asset based on MFRS 16, paragraph 23. So it stated that at the commencement date, a lessee shall measure the right of use asset at cost. The second type of initial measurement is initial measurement of the lease liability. So based on MFRS 16, paragraph 26, it stated that at the commencement date, a lessee shall measure the lease liability at the present value of the lease payments that are not paid at that date. The lease payments shall be discounted using the interest rate implicit in the lease if that rate can be readily determined. If that rate cannot be readily determined, the lessee shall use the lessee's incremental borrowing rate. The next part is the subsequent measurement. So the first type of subsequent measurement is subsequent measurement of the right of use asset. So MFRS 16 paragraph 29 stated that after the commencement date, a lessee shall measure the right of use asset applying a cost model where cost first, less any accumulated depreciation and accumulated impairment losses, and second, adjusted for any remeasurement of the lease liability. The second type of subsequent measurement is subsequent measurement of the lease liability. So MFRS 16 paragraph 36 stated that an entity shall measure liability by increasing the carrying amount to reflect interest on the lease liability. The second is reducing carrying amount to reflect lease payments made. And third is remeasuring the carrying amount to reflect any reassessment or modification. The table below shows the presentation of Aeon Corporation in the year 2021. So based on MFRS 16 paragraph 47, it stated that a lessee shall either present in the statement of financial position or disclose in the notes first right of use assets separately from other assets. If a lessee does not present right of use assets separately in the statement of financial position, the lessee shall include right of use assets within the same line item as that within which the corresponding underlying assets would be presented if they were owned. And second is disclose which line items in the statement of financial position include those rights of use assets. And the second one is lease liabilities separately from other liabilities. If the lessee does not present lease liabilities separately in the financial position, the lessee shall disclose which line items in the statement of financial position include those liabilities. The table below shows how Aeon Corporation did practice on initial measurement. So it's stated that as a lessee, the company recognizes a right of use asset and a lease liability at the lease commencement date. The ROU asset is initially measured at cost, which comprises the initial amount of the lease liability adjusted for any lease payments made at or before the commencement date, plus any initial direct cost incurred and an estimate of cost to dismantle and remove the underlying asset or to restore the underlying asset or the site on which it is located, less any lease incentives received. So this paragraph shows that Aeon Corporation meets the requirement for accounting standard, which is MFRS 16 paragraph 23 regarding the measurement. The next paragraph, it says that the lease liability is initially measured at the present value of the lease payments that are not paid at the commencement date, discounted using the interest rate implicit in the lease, or if that rate cannot be readily determined, the company's incremental borrowing rate. Generally, the company uses its incremental borrowing rate as the discount rate. So this paragraph also meets the requirement stated on MFRS 16 paragraph 26 regarding the measurement. The next table shows how Aeon Corporation uses subsequent measurement. So it stated that as a lessee, the ROU asset is subsequently depreciated using the straight line method from the commencement date to the earlier of the end of the useful life of the ROU asset or the end of the lease term. The estimated useful lives of ROU assets are determined on the same basis as those of property, plant and equipment. In addition, the ROU asset is periodically reduced by impairment losses, if any, and adjusted for certain remeasurements of the lease liability. The next paragraph stated that the lease liability is measured at amortized cost using the effective interest method. It is remeasured when there is a change in future lease payments arising from a change in an index or rate, if there is a revision of in substance fixed lease payments, or if there is a change in the company's estimate of the amount expected to be payable under a residual value guarantee, or if the company changes its assessment of whether it will exercise a purchase, extension or termination option. Next, we are going to the third part of other liabilities, which is deferred tax liabilities under MFRS 112. So what is deferred tax liabilities? Deferred tax liabilities is the amount of income taxes payable in future periods in respect of taxable temporary differences of rules on accounting method and tax method. So what is taxable temporary differences? So MFRS 112 paragraph 15 stated that a deferred tax liability shall be recognized for all taxable temporary differences except to the extent that the deferred tax liability arises from the initial recognition of goodwill or the initial recognition of an asset or liability in a transaction which is not business combination at the time of the transaction affects neither accounting profit nor taxable profit, which is tax loss, and the last one is at the time of the transaction does not give rise to equal taxable and deductible temporary differences. So in the table below, it shows how Maybank Berhad stated its or present its deferred tax liabilities in the statement of financial position. The last part of other liabilities is regarding to employee benefits under MFRS 119. So MFRS 119 paragraph 8 stated that employee benefits is all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of employment. So there are 4 types of employee benefits, which are short-term employee benefits, post-employment benefits, other long-term employee benefits, and termination benefits. The table below shows how Maybank Berhad disclosed its information regarding short-term employee benefits. So based on MFRS 119, paragraph 25, regarding disclosure, it says that although the standard does not require specific disclosures about short-term employee benefits, other MFRS may require disclosures. For example, MFRS 124 requires disclosures about employee benefits for key management personnel. So that's all from me. I'm going to pass to the next presenter. Thank you very much.
Next, for additional information, we will see the liabilities in current issue. In this issue, I use Asia as example. Due to COVID-19, the government have implemented closing of borders, travel restriction, stay-at-home orders to reduce the spread of COVID-19. As a result, the aviation industry has been hardest hit by the pandemic due to the closure of geographical borders. This has severely restricted air travel, specifically international air travel, causing a sharp decline in revenue. In turn, airlines including Asia are facing operating cash flow challenge and operating losses which could lead to insolvency. So, to prevent insolvency, the company doing the mitigation, which is mitigation is the process for identifying and implementing action to reduce or eliminate business losses. The group, Asia has outlined restructuring plans to deliver cash flow, undertake cost optimization, secure fundraising and loans, and negotiate lease or payment terms with vendors. They are also monitoring yearly indicators of travel recovery and actively strategizing their next steps accordingly. So this is what I got from annual report of Asia. As we can see at the top of the slide, there are net current liabilities or net current asset of the company from 2017 until 2021, and the big table shown the total equity of the company from 2017 until 2021. For year 2020 until 2019, it was not a problem to the company. But starting in 2020 and 2021, which is the year of the COVID start to get worse, The current liabilities exceeds its current asset by 5,000 million on 2020 and 6,000 million on 2021. The spread of the COVID pandemic after the year end has significantly affected Asia's operations. So the problem is the equity for 2020 and 2021 is negative, which means if an asset has been sold to reduce the company's liabilities, but there is still a balance of liabilities even though the company has exhausted its asset, that equity will bear the balance of those liabilities. But in this issue, the equity of the company is negative and company has no other funds to bear their liabilities, which means the company has debt that cannot be covered by current asset and also cannot be covered by equity. This slide shows on 2020, AirAsia auditors says airlines' future is in significant doubt, which means when COVID-19 started, it has affected the financial performance and cash flow of the airline. But on 2021, AirAsia received over 90% support from creditors for debt restructure, which is two classes of creditors gave 100% support to AirAsia, and Airbus has also agreed to reduce AirAsia's existing order. This will help AirAsia to reduce the liabilities of the company. So the purpose I show this is to show how AirAsia finds their initiative to reduce the debt and what are the efforts made by AirAsia to overcome the issue. I took this from notes of financial statement AirAsia. AirAsia have implemented several measures to weather through this current challenging time. These efforts are ongoing as the AirAsia continue to seek support from their vendors and business partners to address its cash flow requirements. The measure had been taken in 2020 is in terms of funding to shore out liquidity. AirAsia secured term loans and revolving credits of 300 million secure from a financial institution, sale and leaseback of 7 engines which risk approximately 400 millions, and dispose 33% equity interest in which risk 150 million in addition to the above. Asia is currently undertaking under initiative which is application of funding under Dana Jamin Prihatin of amount 1 billion with the relevant financial institution and propose issuance of debt instrument to raise approximate 1 billion. In terms of working capital management, AirAsia is currently in discussion with its lessor to negotiate the restructuring of lease to waive the lease rental as well as reducing future lease rates. And Asia also has significantly reduced its cash burn rate through implementation of cost-cutting measures such as right-sizing of manpower, salary cuts for management, staff and directors, negotiation of deferral with lessors, suppliers and partners, and others. And on 2021, for funding, AirAsia has undertaken several funding initiatives, including restructuring and renegotiation of lease, and still do the disposal and AirAsia in various stage of discussion with lenders and inventors for debt and equity fundraising amounting 1.5 billion. For the working capital management, AirAsia still sizing of manpower and salary cuts for management, staff and directors, and still negotiation of deferrals with vendors and other business partners. That means AirAsia still using the initiative from year 2020, and there's an additional initiative that could help AirAsia to reduce their debt. So, the impact to the company if current liabilities exceed current asset, the company is not even able to meet its short-term requirements, company will cashless, risk of loss will be greater to the lender, and the company may go insolvent due to negative net asset. So, the conclusion is the company's liabilities need to be well managed. If the liabilities exceed the asset, it can force management to close down the company, which is it can file for bankruptcy, liquidate, and go out of business. Liquidate means they are selling the asset to settle the liability. If it will not even cover the liabilities. It means shareholders will get nothing from the company, and the company also will lose shareholders. So that's all from our group. Thank you.